Hello, my name is Spencer Cohen. I'm principal and founder of High Peak Strategy, which is an economics and research consulting firm based in Seattle, Washington. I'm also a past fellow with the National Committee on U.S. China Relations Public Intellectuals Program Fellowship, or PIP. I'm very pleased to introduce our guest for today's interview, exploring the current state of U.S. China economics and trade, with a particular attention to the impact of tariffs on that relationship, which has obviously gathered a lot of attention and news over the last few months now. I want to note that we're having this conversation at a time of rapid shifts in U.S.-China trade. What's true today might not be true next week, so I ask our audience to please keep that in mind. Things have been very volatile. A lot of things have been changing in the news, as they've all noticed. So we'll please be mindful of that in our conversation. So briefly, I'll introduce our speakers. Their full bios can be found on our website. So Claire Reade is Senior Associate with the Trustees Chair in China Business and Economics at Center for Strategic International Studies, or CSIS. From 2008 to 2014, she served as an Assistant U.S. Trade Representative for China Affairs in the Office of the U.S. Trade Representative, or USTR. Andrew Greenland is an Assistant Professor of Economics with a joint appointment at both the Poole College of Management and the College of Agriculture and Life Sciences at North Carolina State University. So let's just jump right in. Between January 20th, the inauguration, and April 11th, 2025, President Trump ignited a new phase in the U.S.-China trade war, beginning with a 10% blanket tariff increase on already quite high tariffs on Chinese imports that eventually escalated to an average tariff of 145% by early April. China retaliated with tariffs reaching 125% on U.S. goods and imposed regulatory measures against American firms. The rapid escalation severely strained trade relations in global markets, prompting fears of long-term decoupling. So we'll have time to return to what's been happening over the last several weeks, including what just recently transpired over the weekend in Geneva. But Andrew, I'd like to ask you first, to kind of kick things off, to provide some historical perspective. So how do we get to this moment in the U.S.-China's trade policy? Can you tell us a bit about the U.S.-China trade policy as it looked like, and how are these tariffs how do they have historically been used in the United States?
Yeah, great. Thank you so much for having me today. And I'm very happy to give you a little bit of historical background here while we get started. To do that, I'm actually I've got two graphs I've kind of prepared, I think, that are going to summarize kind of the history of U.S. trade policy with respect to tariffs, and then with respect to China in particular, that'll be useful for putting some perspective on this. And so what I'm going to do very quickly is just share a figure here, if I may. Is that on your full screen? Can you see that? This is going to give the time series basically of what the U.S. tariff rate looked like over time. And when we look at it, there's a couple of key features. In the modern times, up until President Trump took over, this is the area we typically refer to as the period of hyper-globalization. Tariff rates are already really low, like 3%. But this is where we're signing deals like NAFTA, Canada-U.S. Free Trade Agreement, Israel Free Trade Agreement, a bunch of these like bilateral things that are basically promises to other countries that we're going to keep economic relations stable to really make sure that firms don't have any risk associated with integrating supply chains. When we go back, there's a bunch of increases in tariff that happened over time. Before we get to about Smoot-Hawley, tariffs are used a lot for a source of revenue and a way of sort of protecting labor markets. But then after World War I takes place, and after World War II takes place, there's a really marked effort to really try and cut tariffs down. To put the modern tariffs in context, even when they were an important source of revenue, they didn't hit an average tariff rate of 30% until we go back before 1900. So this is really a shocking increase in tariff levels. We basically use the GATT, or the World Trade Organization's precursor, as a means of cutting tariff rates over time. And the way they were set up is we had these things based on the Smoot-Hawley tariff. I think a lot of people have heard of that, but this was really the only tariff schedule that the U.S. had. And then basically we gave deals based on whether or not you were in the GATT to countries, and then cut those rates. But if you weren't in the GATT, you got stuck at these 1930s Smoot-Hawley tariff levels. And China was stuck in those 1930s tariff levels. Okay, so when you look at U.S. tariff rates with China, we didn't let them really get access to the U.S. with low tariff rates until 1980. Before that, they were kept on what are called the column 2 rates. These are basically for anybody who was in a non-market or communist economy. And on a temporary basis, we offered them what's called normal trade relations, which said, we're going to actually give you access to these MFN, these lowest rates we have available to even our closest economic partners. But because China was at such a very high tariff rate to begin with, this amounted to a 30 percentage point cut in the tariff rate, basically in the course of a year. And so that's a very rapid cut. We did this on a year by year basis, where if China, we didn't think they were behaving or we thought there was some kind of economic problem, we would let Congress re-vote on whether they wanted to give access to China to these low rates or send them back up to this 40% average. Okay. It wasn't until really we get to China attempting to enter the World Trade Organization when we actually have a shift in policy here and we offer them what's called permanent normal trade relations. So in 2001, when we offer this permanent status to China and they're able to enter the World Trade Organization, this is going to do for China what all of these trade agreements did for the US in the 1990s, which is guarantee this stable economic and business environment, which led to a lot of acceleration in U.S. China trade. And this has been the focal point for quite some time of what economists call the China shock, or this recognition that offering China access to the U.S. market in this way could have been very disruptive for labor markets.
Thank you. So, Claire, events from the first Trump administration also provide some very helpful context for what we are seeing today. U.S. China trade conflict began in earnest in 2018 when the administration imposed tariffs on hundreds of billions of dollars worth of Chinese goods, citing unfair trade practices, intellectual property theft, and trade secret theft. From your background with the USTR and your expertise, can you tell us a bit about what happened then, the underlying issues that prompted that first phase of the trade war, and what resolutions were reached?
A number of concerns had been bubbling up inside the United States and abroad, where a relatively stable consensus that there should be an effort to draw China into the global trading system, and that drawing China in would be very positive. Including for some, that it would cause China not only to change its economic system so that it melded better with the other economic systems in the world, but also that China would potentially change towards more democratic norms. But by the time Trump got into office, it was pretty clear that China's economic system was in many ways at odds with the rest of the, I'll call them liberal market economies. And China's size made it very problematic because when China did something that didn't work for the liberal markets, it was too big to ignore. And the distortions were growing very significant. So even before Trump came into office, the U.S. Sort of concerns about China and the impact of China's economy on the global trading system were quite significant. And Trump put it on steroids, if you will. There was an investigation under part of our law that's called Section 301 of the Trade Act of 1974, and that allows the president a great deal of leeway to put restrictions on trading partners when they take actions that are discriminatory or unreasonable or otherwise problematic. So that's what Trump did. And there were citations of a number of problems, including cyber theft, intellectual property theft, technology transfer, that generated these tariffs. And then came China's response, which for China watchers was not at all surprising. China would not back down. And then we ended up with a, I don't know, testosterone-fueled retaliation, counter-retaliation pattern for a while until both sides decided they'd had enough.
Just kind of following up on that, and also specifically to some of the comments from Andrew as well. Andrew, you mentioned the China shock, and I think Claire, you also kind of alluded to that too, with sort of the how much the trade agreements did not yield the kind of outcomes we were hoping for, particularly with China's extension to WTO. So I'm wondering if Andrew, you mentioned China shock. Do you have any comments, or if you could comment on the China shock argument, and maybe explain a little bit what it is and some of the strengths and weaknesses in explaining U.S. deindustrialization in certain parts of the country.
Yeah, absolutely. There was a really important study that came out by three authors, Otter, Dorn, and Hansen, who put out a paper called The China Syndrome. And it was the recognition that places that were specialized in things that China was about to have an export growth surge in saw much lower growth rates than their less exposed counterparts. So you could imagine thinking about a labor market where I had factories that were producing things that China's about to be good at, and I'm going to compare it to another location that doesn't have as many factories. And what we observed between those two locations is the places that were more exposed to Chinese import competition, as it's termed, ended up seeing greater separation from the labor force, more governmental transfers into those locations that would look like unemployment benefits and things like that. And so there is this, and there's been a number of studies who have used this same kind of strategy to look at implications of this kind of manufacturing-based job loss for things like funding of public schools, for quality of education, for what kind of jobs kids will get, what kind of schooling decisions they make. And so there's really been a lot of attention paid to this particular set of stylized facts. There's really two parts to this. I think there is some truth to the fact that there were manufacturing jobs that were almost certainly offshored and relocated to China, and for a lot of economic activity in these communities, they will have suffered some harm due to those losses. There is also the related point, though, that the way these studies are conducted is they're not actually able to say that that increase in competition from China was necessarily made worse off than it would have been otherwise. What they can say from a statistical standpoint only, just the way these studies are actually conducted, is that they didn't do as well as their less exposed counterparts. Now, that could mean that both of them did worse, and these exposed places did much worse. It could mean that both of them actually grew, but they just grew less slowly. And there's been a bit of I think, a misunderstanding in translating from the economic research that has actually been studying this to a statement in the political sphere that sort of says, these studies say that import competition made these places worse. That's true, but worse than what? Worse than the places that we're comparing them to. That doesn't mean worse in an overall sense. There have been a lot of things, including linkages in supply chain, lower intermediate input costs. All of those things actually boost employment. And so it's a tricky thing to weigh these. And I think it's just important to kind of have an understanding that these studies, which were meant to talk about relative trends in the US, can be taken out of context to say things that aren't necessarily implied by the analysis that they've done.
So question for both of you now, pivoting to President Biden's administration and then Trump 2.0. So President Biden, when he came in office, largely maintained the Trump's tariffs with some adjustments. What was Biden trying to accomplish? Was he successful? And this is specifically vis-a-vis the U.S. China relationship and economic trade relationship. So was he successful? And how did China respond? And as a follow-up to that, how has Trump 2.0 departed from the Biden approach?
Well, I'll jump in with an initial observation, and that is, I think the Biden administration recognized the challenges that China posed, but also did want to try to potentially cooperate with China in some spheres. But they decided that the concerns they had were concerns that could be best addressed through tools other than trade. So they used export controls and sanctions and looked at investment controls and screening. And they also were very much of the view, which I think is a correct view, that you are not going to be able to counter the problems that China poses to the global trading system on your own. So they worked a lot to try to bring allies on side so that, for example, export controls would work across the board, or sanctions would actually work rather than just causing diversions. I think they felt that trade was potentially not as fruitful an area for trying to curb the parts of the Chinese system and ambition that they thought was most dangerous. At the same time, I think politically it would be very difficult to pull back from the tariffs that Trump had put in place, because the premise for those tariffs, including intellectual property theft and subsidies and all of the bad acts that China had been accused of, were certainly not going away.
Yeah, I would agree with that. I think for the most part, there was at least a recognition that this needed to be done in a multilateral capacity and thinking about how to deal with this with some important caveats. I mean, the dispute resolution mechanisms inherent in the WTO have been sort of incapacitated both through the Trump and Biden administrations, where both of them have blocked the appellate body from reaching a quorum. And that's the place where people are going to make complaints and formally try and hash these mechanisms out. I think that emphasizes the displeasure with how the body has been able to handle problems vis-a-vis China, and they're both presidencies are just taking a different strategy, I think, on trying to approach that issue going forward.
And if I can drop a footnote on the WTO problem, I think there was a sense that the WTO rules, as much as they had tried to address what they thought the China challenges would be, were not successful entirely, and that there was a lot of Chinese behavior that could take place and not be caught by the WTO rules. And then the problem was that the WTO works via consensus. There has to be unanimous view for there to be a change or an addition to a rule. And China, of course, could block any changes that they would view as adverse to them. So it was a pretty complicated and difficult puzzle at the WTO.
I want to Claire, as a follow-up, can you explain what, or just some examples of where the rules as they were set up, or the conditions for China's extension to the WTO really we weren't able to modernize those to reflect the realities of that relationship? I know, for instance, China, I think was classified as a developmental state, or development state, or developing economy, I should say. Can you explain that a little bit?
Yeah, well, I think the big problems related to some of the forms of subsidy that China had, and the idea that a private company in China is not necessarily very private. It actually has state control and can have state money, the way the whole banking system works, and financial support going to national champions, provincial and local government support. These are aspects of the economic system that create very significant distortions. They make it very difficult to operate inside China if you are trying to. And the other problem that they create are these, what is called overcapacity in China, that then results when they don't have sufficient demand, which may be due to inadequate consumption by their consumers, but they don't have sufficient demand. And so the output pours into the global economy and destroys, solar industries in Germany and very steel across the world. I mean, the stunning statistics, China doesn't have any iron ore at all. So it doesn't have what one would consider to be a sort of 19th century comparative advantage in this industry, but it is now dwarfing the rest of the world in this product. So the system was creating a lot of difficulties, both subsidies and state enterprise. And frankly, the WTO issued the appellate body, the top, dispute settlement body, issued a very problematic decision in which they were very, I think, myopic about the Chinese system and refused to view a state-controlled entity as if it were part of the state. They took quite a narrow, rigid perspective, and I think that really bothered the United States.
And just one more follow-up on this. This is an interesting topic. So when the Biden administration opted or did not pursue allowing the dispute resolution to function again, WTO, was that an active strategy, or was that was it much like the tariffs, where there was really no reason to reduce the tariffs in the same way that there was no reason for the administration to pursue a different course from the Trump administration on WTO?
Well, the Biden administration did work on the idea of WTO reform, including reform of the dispute settlement process. It's just that it took a while, and I don't think it crossed the finish line, for other countries to really recognize the kinds of problems that the United States saw and to be willing to try to work on them. But there have been efforts. They haven't succeeded yet.
Mhm. And I would just add one note to all the excellent comments on this question is I think the other piece too, which is alluded to, was the investment piece on the differentiating between the two administrations. So the last administration used invest, align, compete as kind of their framework. And so I would think the Inflation Reduction Act and the Chips and Science Act, even though they're not explicitly China targeted, they're implicitly thinking about China and trying to invest in U.S. capacity in addition to those other tools. So
Completely agree that we should have mentioned that right up front, because it was definitely a multifaceted. It was a sort of, don't just try to stop the other guy from running fast, go to the gym so that you can run faster.
mhm. Well, let's turn now to the current tariffs. So the administration has imposed steep tariffs on Chinese imports, that we mentioned before, citing national security concerns and trade reciprocity. And then, of course, China is expected to retaliate in kind. What do you think are the underlying goals of this administration with respect to this strategy, and how likely are they to succeed? So what is the point? What are they trying to do? Like, what's the? I think we've all struggled with trying to understand or hear the administration articulate what's the end game, right? What are they trying to accomplish? But I'd love to hear your thoughts from both of you on this.
I struggled with this a bunch, but the best I think we have to start talking about Canada and Mexico as a starting point here, and why they popped up and why every other country got hit. And I think it's just the observation that when we put the tariffs on, firms readjusted their supply chains and put in multinational production facilities in Vietnam, in Mexico, that might have been owned by these Chinese firms or might have been tightly integrated with them. And, you can look at the trade data and see that there's a lot of trade that used to take place between the US and China is now taking place between China and Vietnam, or China and Mexico, and then Vietnam and Mexico and the US. And so I think the initial response was to recognize that when you're only putting tariffs in a bilateral sense, it's now a game of whack-a-mole where you're trying to shut down the supply chains as they go back. This was an incredibly heavy-handed way of addressing this problem by putting tariffs on anybody who might allow Chinese investment and re-exporting to the US. I think that was the initial feeling, was that they didn't get the kind of reaction they wanted with the first wave of tariffs. There was a problem, that there was a leakage, and they tried to shut that down at the same time. That's the best picture I can put together for how this happened. It is not how I would have designed a policy if that were actually my concern, though. So I'm very happy for somebody to shoot holes in that and explain to me what is actually going on, because that's the best story I can come up with.
It feels to me as if the administration started with multiple people's brains having multiple different ideas about what the purpose was for these tariffs, right? So there was we're going to make a whole ton of money off these tariffs. We can do our big, beautiful tax cuts there, which didn't make sense. Andrew's shaking his head vigorously.
No way.
Doesn't matter.
No way.
That was the political narrative, right? I mean, and I think somebody was thinking that. And then there was we must, China is the enemy. So that became something. But it seems clear in the last week, very clear, that our suspicion that Trump, the businessman, never had the idea that decoupling from China was a good idea. He and then for the other tariffs, I think there was the grievance created by Trump's view of the meaning of bilateral trade deficits, right?
Couldn't agree more. Couldn't agree more.
But those I think all played in, and I think it was a jumble, and to some extent still is a jumble conceptually. But one of the things we are seeing pragmatically is that Besant and the other cabinet members are saying, hey, this was a strategy. We were sort of putting these on as a negotiating tactic, and now we're winning. So that's now, I think, the messaging, even if that may not have been the initial thinking.
I'm okay with a lot of influences and ideas being jumbled, but the problem I have with all of these, like we're going to reindustrialize, the foreign economy is going to pay for it, we're going to use it as tariff revenue. It's not that they're jumbled, they're mutually exclusive, right?
Yes.
You can't actually have you can't actually fund the government on tariff revenue and reindustrialize, because what you're doing is you're still importing things. Otherwise, you don't have tariff revenue. And that's under the assumption the foreign economy pays for it. But if they don't, and you're paying, like, it wasn't just that it was jumbled, it's just that all of the stated objectives couldn't simultaneously be true, like arithmetically. And so I think that's the part where it's really challenging to get a grasp on what they hoped would happen here. I mean, let me just push back on the reindustrialization argument for like 2 seconds. Amortizing the cost of a plant for a firm might be a 10-year decision, right? The break-even point, at which point they're going to say, yes, there's enough labor in this place. We're going to sink a lot of money in capital and infrastructure and setting up supply chains, and it's going to take us 10 years to break even on all these fixed costs. And this administration leaves in 3 years. And we don't know what tariffs are going to be in 2 months. Like, that kind of uncertainty is not going to encourage businesses to make this kind of shift in behavior. And I think of the most comically out of touch arguments was that this kind of volatility in policy and planning and rising input costs could lead to a reindustrialization of the U.S. economy.
Do you see, to completely agree, do you see the end of the first phase of the trade war culminated in this phase 1 trade deal that never succeeded for a lot of reasons, I think, having to do structurally with what it was. The most, I think, controversial part was this essentially a quota for purchases, with the trade expansion component. But do you see that as, from both your perspectives, like, do you think the administration might be moving towards that, like some sort of deal, especially as we move into the domestic political pressure, if we're moving into a midterm season next year, that there might be enough pressure to just kind of get to a deal of some sort, get to some conclusion? Do you see that as a goal, perhaps?
My sense is that Trump has a variety of short-term incentives and short-term pressures. So he has the midterm elections, where if we have a recession or we have significant increases in back-to-school costs or the costs of Christmas presents, or there are empty shelves, it is going to be a very problematic set of midterms for Republicans. So he has that. He also does not want to be Herbert Hoover, the guy, who tanked the U.S. economy most famously. So even if he initially was ignoring the stock market's gyrations, when that bond market started to crash and it looked like investors were actually fleeing the U.S. dollar, that meant something, and it should have, because that was a potentially very serious, problem. So he has both that to pay attention to and this short-term political. Now, on the Chinese side, they have a much longer range concern. They want stability and they want the U.S. off their back. And right now, they probably are feeling pretty good, because the signals that have come are that the United States is willing to do a deal, and they started with tariffs. They talked about non-tariff barriers, and Trump, in his press conference, God, I don't remember, it was yesterday, I think, talked about the fact that they had, in Trump's first term, set up a, quote, really big deal with China, that the Chinese leadership had tanked at the last minute, because that big deal included a lot of commitments by China to change its domestic laws and to stop certain kinds of behaviors relative to subsidies and other and I think it's state-owned enterprises. And Trump, now he's not the most reliable narrator here, but Trump said that China is now open to that, quote, bigger deal. And he said he thought the biggest thing that we could get out of this was China opening up to US business so we could make money there. That's really interesting to me. And that's an indication to me of a narrow deal. It's not going to stop the national security investigations and the restrictions and export controls in the national security space, but it feels as if Trump is signaling a real desire to have, I don't know, normal commercial flows with China. Although 30% tariffs, Andrew can speak to that, may not get us to normal flows.
Yeah, I mean, I think from my standpoint, I think the reality is, as much as Claire pointed out, the devaluation of the dollar and the bond market yields rising at the same time as the stock market was collapsing was the moment of the quick heel turn, right? Like that was the time where you realized that things could get a lot worse, right? And the market has started to rebound some, but the dollar is still down quite a bit. So in real terms, this is still a big loss. I think the thing that's going to put the pressure on the administration right now is, these tariffs have the potential to be really nasty in the sense that they could both be inflationary, causing price hikes, but also causing unemployment. And the real pickle there is that is a notoriously challenging position for the Fed to be in. That's one of those, you get into a recession and you have high unemployment and high prices, and the Fed can fix one of those at a time. And so I think the administration thinks it has room as long as the numbers for the CPI and employment don't both look bad. They can cause a problem and kick it to the Fed to handle it, as long as they don't kick the Fed two problems at the same time. Because one of those problems the Fed will cut rate for, the other problem they'll hike rates for, and if both problems are happening at the same time, they're going to have to make a very, very tough call. And so I think the administration is going to look at the numbers. It's going to say, we gave firms warning enough to build up inventories at the beginning of the year in January, February, where we threatened tariffs, told them they were going to come in and put a pause on them. And until we actually see firms running out of these inventories and price hikes rising and unemployment start going up, I think the administration is going to look at this and say, we have some room to play hardball until this starts to bite. And the hope, I think, for all of us, is that by the time this starts to bite, there's enough time to backtrack before things get nasty.
So very briefly on that point too, like what are you seeing? What are you tracking with respect to supply chains? Andrew, you had mentioned before too about the volatility and the long-term investment decisions that have to be made, and how about that uncertainty is not the friend of business. And so I'd love to hear both your perspectives. Just what are you hearing about supply chains, volatility? There have been several indices that have come out recently showing a lot of the sort of the, elevated volatility and uncertainty in supply chains and long-term planning. I'm just curious, what are you both hearing with respect to how all of this volatility and tariff rates is affecting supply chain decisions and just supply chain operations?
Well, just anecdotally, and then Andrew can speak systemically and with much more expertise. But anecdotally, it is very much the case that businesses and you, Spencer, may also have seen this with your clients. It's very much the case that businesses can't make decisions. They can't. They don't know where the tariffs are going to be. Folks that were shifting from China to a third country, to try to do, China plus one or instead of China, it's very difficult to know if these tariff deals are not going to come off. And the prospect of a baseline 10% tariff where we started with a 2.5% tariff, as that's also additional expense. So that's uncertain. So it's it's a very, very challenging time, and I think we've got a lot of paralysis, intelligent paralysis from business.
I think it's the same thing. I think it's a wait and see mentality. And I think the reality is the firms that have got these inventories that were able to build it up before the first wave of tariffs hit, my gut is that these are much larger firms. Okay. These are firms with very large integrated supply chains, access to big capital markets, national distribution. The people who are going to start feeling the squeeze on this are the smaller firms who are buying from wholesalers, who are stuck in sourcing inputs internationally that have already gone through some set of markup by the time they have an opportunity to pay for them. And so these are going to be smaller firms, more mom and pop shops, less economically integrated and able to diversify against these shocks. There's a lot of wait and see right now. And there's a lot of trying to see just how much of this trickles down the supply chain. I was doing a home renovation project and had somebody actually come in and give me a quote. And they said, well, normally I would show you this set of LEDs, but we got some notification today from our boss about these tariffs. And I said, they were probably like, you don't care about this. I was like, actually, you might have run into maybe one of the handful of people on the planet who would be very interested in seeing that piece of paper. And it was just like, hey, there's 145% price hike on this particular set of things. And it's just like, they're like, how are we going to sell these? I was like, oh, I can answer that for you. You're not. You're going to start dropping the variety of products you sell to the ones with the high markup, and you're going to see loss. And that's going to be the real risk here, is that there are going to be firms for whom the optimal response here is to focus on their core competency, the things with the high markups, where that they can afford, if they have to eat some of this increased cost that they're being passed, and their consumers will eat some of that increased cost. But the stuff that's on the fringe, or there's small sets of firms, or loss of variety is going to be a real feature of this, unfortunately.
And I think also for very small businesses where they set themselves up, where they have a single supply chain because they don't have the capacity to have choice, and where their capital is tied up, so they don't have the capacity to gather inventory, or they're just a young business and they may not be able to take the risk of having inventory without sales. Those folks are really going to continue to feel pain.
So one last question for both of you, very, very quickly. I would just love to get your take. So over the weekend, we had a meeting in Geneva between the Chinese representatives and U.S. representatives that culminated in a truce, essentially, a 90-day truce. U.S. agreed to reduce the average tariff from 145% to 30%, which is still incredibly high. And China also agreed in turn to reduce from 125% down quite a ways as well to 10%. I'd love to just get your perspective on what happened in Geneva. Just very briefly, what's your take on what's happened in Geneva? Do you see this truce as signaling a broader policy shift in the second Trump administration toward China, or is it just a tactical move to ease immediate economic pressure? And then what are you keeping your eye on for the next 90 days? What do you expect kind of might potentially develop over the next year, in the near term following this?
I'm watching unemployment, CPI, and Fed behavior. That's the stuff I'm really interested in here, and I think they're interested in those things too. Is just trying to figure out how much of this is going to work its way through the supply chains and is hitting firms already on this wait and see side. I mean, look, when you have a 10% base and 30% tariff, and these are in addition to some of the pre-existing stuff, at some point, you have 145% tariff or you have a 10,000% tariff. It doesn't matter, right? You've choked out those supply chains. And so seeing it come down to something that was akin to what China was facing in 1979 is still extremely high. I mean, you're still talking about, to the extent that those costs are fully passed on or even partially passed on, a 30% cost shock is a lot for firms to deal with. And so I want to be cautious about, I'm glad it didn't get worse, but once you're already choking the supply chains, worse isn't really an option. So I guess it either had to stay the same or get a little bit better. And I'm glad it's a little better, but I don't want to do too much celebrating yet.
And in terms of what happened, I don't see it as I see the pivot having occurred once there was a realization that the bond markets and the dollar and you know, as Andrew said, also the stock markets were all really getting into a chaotic downward spiral that looked really dangerous, not simply a fluctuation for the short term. So I think that's what changed the attitude. And then I think the group that gathered in Geneva over the weekend was the correct group. You needed someone very high level from China. Vice premier level is sort of the minimum. And you had two cabinet members from the administration who know what they're doing, one on the macro side, one on the trade side. There also was the Minister of Public Security from China, so signals on the fentanyl piece. And I think it's a pretty savvy group, actually, that's going to be negotiating the details from here. The question is, what's the scope of what they want and what is it that they can get that's meaningful? Whatever it is, Trump will, unless he gets mad and, you know, there's a deal that he feels gets pulled out from under him that was agreed, that's what happened and Trump won. But if we avoid that, then I think he will probably declare victory. And the question is really, what is it we're going to get? Are we going to get more purchases of U.S. goods? What else is going to change? It remains to be seen. So watch and
Well,
wait.
we'll still have another conversation like this in 90 days, perhaps, or might need to have one. Well, I would love to thank you, both of you, for your amazing expertise and sharing your thoughts and insights for us today. I'd also like to thank the National Committee staff members behind the scenes who have made today's interview possible. We hope those who have tuned in today found the interview both interesting and informative, and that you will join us for future National Committee programming. So thank you again, and look forward to continuing this conversation.
Thank you so much. Appreciate being here.
Yes, me too.